Welcome, everybody, to this week's Middle Class Investor. This is Seth Martin. Um, First of all, I want to apologize if I start coughing. I've had something going on now for a while, and it comes up all of a sudden. So hopefully, I won't have a coughing attack here in the presentation. Got a chart of the S&P 500 index up. You can see that. Let's put a weekly up because I got a daily up there. You can see that the S&P was actually down for the week, although slightly, not much down. If you look at the industrials were up but finished off the highs. This divergence, and we can go to the Nasdaq too. Let's see if I've got the Nasdaq in here. Yeah, the Nasdaq Composite. You can see it finished flat, but the Nasdaq 100, which let me pull it up from another location. Nasdaq 100 is right there. You can see it finished up a little bit too, but the Nasdaq, there's a little bit of a divergence. It's been going on for a while now, where the Dow seems to be outpacing the Russell and the Nasdaq. Now that the Russell has recently caught back up, so I've just typed that one in. I don't have it on my listing there. It's RUT, R-U-T. But you can see last week the RUT, I mean it sold off pretty hard. So we've just got this divergence going on. It's something to be aware of. Sometimes it just means that one index or another needs to catch up with the others, and it's not anything to be concerned about. Other times it could be that money is rotating into, big cap stocks that are in the Dow and rotating out of, tech stocks and things like that. In fact, if you look at Facebook has been selling off the last several months, and I don't know why that's coming up, but hopefully that won't interrupt our program. Facebook, Amazon, these have all been leading stocks. You can see Amazon looks very similar to Facebook. In fact, the market rally all through here has been very narrow. Again, usually a sign of weakness, but oddly enough, the indexes just keep going up. So not sure what to make of it. This happens sometimes where you're just not very confident about what's going on in the market. Somebody asked me the other day where this clicker is not letting me click. Here we go. Somebody was asking me the other day, about the market, and I was talking about how there was a resistance at 2080 or so on the S&P, and it literally just went to that. Let's see what this high right here is 2,277. So I was talking about 2280 being resistance. Now it could just pull back a little bit here and then make its way up on and touch this line. But we do have some sort of a pullback coming within the next week or so, just because I wanted to show this. This is the Dow, and what I want you to focus on is this bottom section. See if I can. I guess I really can't. Yeah, I can. Let me zoom in on here. And notice what it says. It says 6th most overbought extreme in 102 years. And this oscillator here, it's the relative strength index. It's the highest in 20, where it peaked right here. The highest in 20 years. So, the market doesn't just go straight up. It tends to move and then pull back and then move up again if it's in an uptrend. If it's in a downtrend, does just the opposite. But I did want to show that because participants in the market tend to herd together, both to the upside and the downside, and you have to really be careful about the time you're feeling really confident is about the time you're going to get whacked. So, but I do believe, I think we've got more upside to this market. In fact, I wouldn't be surprised if we broke out of this pattern, this channel, and then came back and retested, and then resumed a little higher. What's the upside? Max. I mean, once you're at new highs, there is no resistance. So, the market could break out here. Let's zoom in and just have a little what if. It could break out of this, retest here, and then make a new high around 2450, maybe even 2500. I don't know. I hope not, because I'm actually, one of the things that I'm kind of nervous about is that, you get a really big correction real fast, and something similar to what we saw back in the 80s. Let me see if I can pull it up. I'll show you. Many of us weren't even investing back then. We were just playing football with the neighborhood kids and doing whatever. But this move right here, let's make it a daily so you can see just how many days it took. I'll zoom in on this right there. So you can see that this move right here, it didn't last that many days. It was from the high to the low, from the high here to the low here was only, what is that? That's 57 days, which is a pretty short period of time. And the pullback there was, let's see what that was. I didn't make note of how much of a pullback that was, but that was a 35% pullback in the market. So in less than 2 months, the market pulled back 35%. So one of my things is I've been keeping a short position, just in case we get something like that. But obviously, I'm gonna have to close that if this climb upward continues, or sell calls against it or something. But the reason I have it on is because there was a possibility that you could get in less than maybe 2 weeks, you could get a move right, maybe at least to there, to 1700 or something. So that's why I had it on, but I may have to take it off. So we'll see. Well, we had some Fed activity last week. Not sure if people in this group were paying attention or not. Certainly the Fed is something that is talked a lot about. We talked about, once we started getting closes and trading above this line right here, that the Fed would raise rates. And so, true to form, Wednesday on December 12th, around 2 p.m., they announced that they raised another quarter point. So the short-term overnight lending rate between banks and checking accounts, like if you get interest on your money market, things like that, it has now gone to 0.5%. So you can get a nice 0.5% per year rate of return on your savings account in your bank, which is just lovely. The 10-year has been rocketing upward too, as you can see here. We initially had talked about, when we were doing some what if scenarios around this, we were talking about it moving up, maybe retesting, and then moving out. And as you can see, it's been strong enough that we didn't really even get a retest. It kind of paused right in here. Kind of paused right here a little bit, but then it just took off. So probably when the Fed saw this, and then this gap, you got a gap here on rates, they probably said, we got to raise rates. So Now, I don't know how much more there is here. There's a pivot right here, okay, which is, just above this pivot is a very natural place for the market to pause, kind of retrench and then take off again. But it may not stop there. I mean, who knows? It looks to me, looking at the bond market, that is very oversold, and we could easily get a pullback. Yeah, lost my. Let me start over here. We could easily get a pullback and fill this gap. So you could easily get a pullback into this area, and then and maybe even deeper, maybe even down into here, and then start back up again. But I think this is a pretty significant move in rates in a fairly short period of time, which tells me now it was this was a fairly significant move in rates in a fairly short period of time. So, who knows? They could certainly roll over and go back down. I think if they roll over and stop going down, uh-oh, this is what I was talking about. Sorry about that. I think if they roll over and start going down and stop here and then begin to bounce, you better be out of bond funds, because this right here, just this little move right here, probably cost you 10% in your bond fund, going from 1.8 to 2.6, at least 10%, maybe more. So be careful with bond funds. I've been saying that for a long time. The trouble in 2008 was there was a lot of commercial and consumer debt. We still have a lot of consumer debt, but the housing market's been, I don't know, it's kind of back up again, actually. But a lot of the debt in 2008, 2009 was just replaced by sovereign debt, or debt, country debt that the country was taking on. So, that can create problems in the bond market, and we're likely to see really high interest rates in fairly short period of time. Now, what's really high? Okay, well, let's look at the last 20 years, and you can see I've got this box drawn on here. Technically, I should have another one drawn right up here where I have this line right here, but maybe within the next few years, during the Trump presidency, we could see rates in this area right here. Let's just move it over a little bit. That could very easily be interest rates in the next 2 to 3 years right here. So we're talking about 6%. And 6%, the big problem with this move is when we roll over our $20 trillion in debt, what we've been doing is, what happens is we don't ever actually pay it off. When it comes due, we just roll it back over. But we have to roll it over at whatever the interest rate is at the time. So eventually, all 20 trillion will get rolled over, and then whatever new debt is on there, it'll all get rolled over at some higher interest rate. So let's say that interest rate averages around 6-7%. Well, at 1.5%, our interest on the debt is about $450 billion. So you can, let's just say, triple that. So now you're up to about $1.2, $1.3 trillion just in interest on the debt. And that doesn't include any new debt we might add. So obviously this rise in interest rates is going to it'll cause problems for people wanting to buy cars, buy houses, all kinds of stuff, but it'll certainly cause problems. Mostly it'll cause problems with our government trying to borrow money, because the reality is what happens is when cars and houses and stuff like that, when the interest rates move up, cars just get cheaper and houses get cheaper to offset, the increased cost of money. But that debt that the United States has on its books is not going to get cheaper. It's only going to get bigger. So anyway, we got some issues there, but I don't want to get too political. I'll start getting angry. I don't want to get angry here on the program. This is the VIX. And you can see now we're starting to trade below this box that I've drawn in here. And to me, this is really, really dangerous. I mean, when people start believing that a new bull market can start from where we are on the S&P 500, you should really start being concerned. A new bull market is not going to start from this area right here. Oh, shoot, I did it again. Sorry about that. A new bull market is not going to start from here. It's going to start from an area after something like this or something like this. Certainly, we would need a pullback probably into this 1400 area before we could even think about starting a new bull market. But certainly, we're not going to start a new bull market from here. So the next 5% could very well be up, but the next 25 or 30% move is definitely going to be down. It's not going to be up. So, which means you have to be quick to make a decision if things start to look ugly, because again, the next 5% could be up, but the next 30% is down, not up. Okay, so hopefully everybody understands what I'm talking about there. All right, well, we've looked at the indexes. Let's take a look at. There's really nothing happening in these other countries. Germany still seems to be locked in this little flag or downtrend. This could very well just be a pullback as this trend, comes up. But certainly, it's. Let's get back on a weekly chart. This has been lasting for some sort of time, and it'll last as long as it lasts, and then turn and start going. It almost looks like it could break out right here. We'll just see, but the UK looks like it's sideways now. It's kind of broken out of this downtrend, but now it looks like it's trading sideways. I mean, if the UK breaks out of this 33 area, I mean, you could see it maybe go here to 38, maybe even to new highs here. So keep an eye on that. Japan, we've talked about it's kind of grinding its way up here, and we don't have any reason to believe that that's going to be any different. It's going to probably just continue to grind. You can see how grinding, it's just grinding its way higher, kind of staying above these moving averages. Let's go look at the dollar. The dollar, everybody's all excited about the dollar. It's been that way for a while now. You can see the little yellow zone that I've got drawn on here. Well, you could see it until I did that. And expecting the dollar to continue to move into this area before it pulls back next. Gold has been pulling back pretty hard. It's about done, if not already. It busted right through our yellow box there below this pivot right here. There was a pivot right here and one here. I guess they're basically at the same height. There was a double bottom here, so we had a box drawn here. And you can see we've blown right through it, and probably, I mean, it could pull back even a little further. Sometimes these big candles like these act as support, so a lot of times you can kind of look, cut one in half, and that'll be support. So, I think gold is about down. If it's about done going down. If you look at sentiment around gold, it's very, very bearish right now. And I mean, there's only like 4% bulls or something. And when you see a situation like that, usually it's about to turn. So if next week we get a bar that closes above this bar right here, then I think you're going to see gold kind of make its way back up, to new highs, something above this 1400. Not to new all-time highs. It'll just be some sort of intermediate move, you know, like into this 1450 area, maybe something off of these pivots here around 1452. In fact, let's take this box here and just move it up here to this location. And let's put that as our target for gold after it stops going down. So if you want to be long gold, again, if we get a breakout above this past week's high, then you might see gold just grind its way up here into this 1450, 1475 area, and that's some pretty good profit right there. 1140 to 1450, 1475 is some good money. So certainly, if you're interested in trading gold, you might want to keep that in mind. Silver, same thing. It didn't go through this box here. It might not even make it to the box. It's real close to this pivot right here. And gold and silver usually don't get too far apart. Let me see if I can get this centered somewhat reasonably. Okay, so you can see this pivot here that happened back here, and this is where we kind of put our box. This box is a little bit low for that pivot. The box really should be, more like this. In fact, let's just change that. I'm not sure why it's that low. Might have accidentally bumped it or something. Get there and there. So we might make it all the way down to this. We might not. Again, these pivot areas are just areas. They're zones. So you don't want to. If you get a buy signal above the zone, then you want to go ahead and take it if you're trading silver. All right, the euro continues to fall. We had this triangle drawn, and you can see it almost made it to our box, but it did break out, and you can see we've had this line on here for a while, and it might be through going down. It might need to go a little lower, but maybe this particular move is done, and we might see a kind of a retest of this line here. We might get a retest of this line, so you might see this make its way back up like this, and then sharply down again. So the euro's locked in a downtrend. I mean, really, there's a lot of bearishness. There's a lot of concern in Europe about Deutsche Bank, the Italian banks. That concern hasn't seemed to come to the U.S. market yet, but that could be contagious. Banking issues in other parts of the world do have a tendency to, have effect on our market here. So, looking at oil, you can see oil has been kind of grinding its way higher, and it's firmly in our resistance box here. You can kind of see it there. It's hard to say if oil is going to go much higher here or not. I mean, it could come to this pivot area up here, closer to 70. In fact, let's just put another box on there. So we could see oil, higher in this area. Well, if it'll make a click there, can't get it to click. There we go. So we could see oil even come higher. We'll just keep an eye on it. There's a lot of bullishness already back in oil. There's people talking about the crisis is over and stuff like that, and usually that's about the time when you get whacked. When you start thinking what's going on and all that kind of stuff. So the British pound JPY has been moving a lot. These are huge moves in the currency markets. Looks like the British pound is bottomed here. Let's look at another one. Let's look at British pound US dollar. British pound still falling against the dollar. This looks very counter trend, so you might get a rally into these lows just below here, and then maybe roll back over. So sorry about the phone. Anyway, that's about it for tonight. Anyway, I just I wish I had better information on the general indexes, because that's what your 401k tends to follow. But I think the odds are that it continues to go up, but maybe there's a pullback first, and again, mainly because the sentiment is just, it's like at 20-year highs, or the RSI is at 20-year highs, and the market, it's like a rubber band, so you can stretch it, but it can only stretch so far, and it snaps back. So you can see we're very high above the 20-day moving average and the 40-day moving average, and probably if I put a 10-day, in fact, let's just look at a 10-day moving average, you're probably going to see that we're even. I have a 10-day moving average. I might not have a 10-day moving average, so let's look at short term. Yeah, okay, so this green line here, let me go back to 5-year. So this green line here, I'll zoom in. This green line is the 10-day moving average, and this is huge, man. When you're, of course, this is 10-week, I guess. Let me back up here. Let me make this a 2-year chart so that this is a 10-day. Yeah, this is more like it. Somebody's trying to get a hold of me. This is more like it, but you can see even here that the 10-day moving average, I mean, the market was really high above it here. It's pulled back a little bit, but I mean, this is really amazing strength here, being this high above the 10-day moving average. In fact, a lot of times if you're in a position and it stays above the 10-day moving average, you just gotta grit your teeth and stay with it. So right now, you would kind of want to stay with it, but this could easily pull back, into here, just below this low here, and then rally up again. So keep an eye out for that. All right, everybody, that is it for the week. Thank you for coming in, and we'll talk to you next week. Well, I say we'll talk to you next week. We might not, because we got Christmas and stuff like that's going on. So it might be 2017 before we talk again. All right, take care, everybody. Bye-bye.